All right, everybody, let's get started. This is Mark Anthony with Mercury Time Price Analytics. Thank you so much for being here today. I don't particularly like canned presentations, PowerPoint presentations, although I've got several of them. I would rather give you a hands-on view of what we do, how we do it, and how that may benefit you. We've got a lot of screenshots to show with you. What we're going to do today is I'm going to show you our automated algorithm. I'm going to show you our proprietary oscillators, our Mercury bands, which are long cycle pivots, our Mercury dynamic pivots. And I'm going to show you the one or two things, and literally that's all you need to focus on to know exactly where the squeeze resides, where they're trying to squeeze the shorts, where they're trying to run the market lower. As you probably know, about 90% of the volume right now is done by automated algorithms, primarily run by the institutions. Now, there are folks that have commercial algorithms available for individual traders, and there may be some good ones out there. I've yet to see them. What makes our system special is that, to my knowledge, this is the only commercially available algorithm that absolutely 100% mimics what the institutional algorithms are doing. Now, I know that's a bold statement, so let me unpack that a little bit. Whether you're looking at algorithms or you're looking at trade services or you're looking at some type of automated system, here's the problem. And I'm sure some of you, if not all of you, have had this experience. The performance results that they show you when they try and sell you something have no resemblance to what happens when you start using it. And the problem with that, there's a number of problems, but one of them is that systems are curve fitted quite often. And by curve fitting, they'll play around with numbers and formulas until they find something that they can see works during some previous time period. But then it ends up not working that way for you. 37 years of trading, this system went into development March of 2019. And if you're familiar with any of the work of W.D. Gann, I wish he were alive to see this. See, the primary reason that most trading systems or automated systems don't work is because they're looking at the wrong stuff. Most trading systems are built on some type of formula pertaining to price. Well, here's the problem with that. Price is linear. Hypothetically, I mean, price starts at 0 and goes to infinity. Well, you can't anchor an algorithm to something on a scale that goes from 0 to infinity. So that's why they look for previous periods that they can curve fit their system into to show you that it works, but it's not repeatable because price isn't linear. The reason I mentioned W.D. Gann, Gann said that time is more important than price. Gann knew it. The people that built the automated algorithms for the institutions and the big hedge funds, they know that. And that's why their algorithms are built on a series of time cycles. Now, they didn't just randomly pick a bunch of time cycles. There's everything from short time cycles, and the smallest algorithmic time cycle is what you see on this chart. It's 12 minutes. Now, you're probably thinking, 12 minutes, where do you get that from? See, the problem is that most traders are trading on charts where the time period per bar has nothing to do with what the algorithms use. A lot of traders use 5-minute bars, 3-minute bars, 10 minutes, 15 minutes, 30 minutes, hourly, 2 hours. Not one single of those time frames are used by the institutional algos, none of them. So if you're trading off those time frames, you're not seeing what they're doing. When you start using the time frames that the institutions use, you will see a completely different picture. Now, all these time frames that the institutions use, they weren't selected at random. there is a very precise mathematical link or sequence between all of them. And when I say sequence, I don't mean just because 12 minutes is the smallest algorithmic time frame. That doesn't mean it's 12, 24, 48, 96, and so on. That's not the way it works. What happens is if you take the longest algorithmic time cycles, and the longest ones are over 6 hours, and you take all the smaller ones, there's about 8 of them, every single one of those smaller time frames per bar is an absolute perfect fractal of every other one. Now, what do I mean by a fractal? Let's say you've got a microscope and you look at something under that microscope at just a basic, say, 10 times zoom. What a fractal means is it doesn't matter how much you zoom in on that. You can go from 10 to 100 to 1,000 to 10,000 zoom. And the closer and closer and closer you look at it, it looks identical. Well, you find that throughout nature. But that's what I mean by fractal. So it's not a matter of just taking one particular time cycle and multiplying it and getting another. It doesn't work that way. There's dynamics in time that are way more complicated than just the numbers that you see on a clock. There's ways this all fits together. And I'm going to share with you some stuff that'll blow you away right in the beginning. If you go to our website, mercurysignals.com, what you see there is the sun and solar flares coming off of it. There is a mathematical relationship between the sun and the planets around us. This isn't astrology. It's astronomy. And truth be known, it's rocket science. It is the same math that governs the movement, the magnetic field, the orbital mechanics of the sun and all the planets. So we call it Mercury, not because of the planet Mercury. Now here's the part that'll blow you away, and I'm going to share with you some things that we normally don't get into on free webinars. Wouldn't it be logical that the same mathematics that govern astronomy would also be present in other aspects of nature? Well, it's true. Because what I found in the periodic table of elements is that if you know the right elements to look at, you find the exact same mathematical structure, the same mathematical relationships, the same sequencing is in astronomy. The numbers that exist in astronomy, if you know where to look and what elements to look at on the periodic table, it is exactly the same. Now, that sounds kind of bizarre, right? But not illogical at all. The planets are made of the same elements, right? It's the same math. So now that we've shared that with you, which again is not something we normally get into on these webinars, what I'm going to show you is the different tools. Now, there's a whole lot going on this screen. So I'm going to break some of these parts down for you. This is the live chart, one of the live charts that our members see. There's actually 2 of them we give you access to. And there's a whole lot of other data and metrics that we provide as well. I'm going to show you the other live chart. This is the main live chart. I'm going to show you live chart 2. Live chart 2 has additional oscillators, and it's also got Apple and Microsoft, because in this market you have to keep an eye on what they're doing from day to day. The automated algo is, I'll tell you what I'm going to do. Let's go over here, and before we do anything else, let me turn notifications off so that we don't see nonsense flying. Okay, they are off, so we don't see stuff on the screen, like an email from Aunt Mary or Uncle Bob. All right, so the 2 primary elements I want to show you on this screen are this cyan line. This is our proprietary momentum algo. Now the interface for this, we designed it to look like the things that people would typically put on a chart. A sloped line, an oscillator, a moving average. There's very powerful math underneath this. The other key component is that when you zoom in, you'll notice that on each bar, you've got two little white dashes. Now, the automated algorithm, which you see in the top row center panel of the member live chart, we wanted to build an, even though there's crazy complicated math embedded in this, we wanted to build an interface that was very, very easy to use. So easy that literally someone with no trading experience whatsoever would have no problem seeing when the algo triggers long and when it triggers short. So there's two things that are necessary, two simple things for the algo to trigger long or short. The first is the cyan momentum algo. What you need is a change in direction. And there's only three things that constitute a change in direction. Either you have the slope change from down to up, as in the shape of a U, from up to down, as in the shape of an inverted U, or the momentum algo is going sideways, and then like the proverbial fork in the road, it either turns up or it turns down like it does here. Now, all that change of slope does is put the system in the ready state, because the price will go above and below this momentum algo many times a day. So all that directional change of slope does is put the system into the ready state. It simply tells you something may be about to happen. Now, after it goes into the ready state, then we look at these two little white dashes, which are a proprietary volatility metric. There's two on each bar. These are 12-minute bars. Each bar is 12 minutes, all right? Now, here's the thing about volatility. When I say volatility, you probably think of VIX. And the thing that most traders don't get, and please know that I mean nothing that I say to be condescending whatsoever. I've been trading for 37 years. Took 35 and a half years to figure this out. But the thing that most traders don't realize about volatility is that volatility in absolute terms means zero. What's important about volatility is the second derivative, meaning volatility compared to itself. It doesn't matter what the reading, the absolute reading of VIX is at any particular moment in time. What's important is the second derivative, meaning in the present moment, right now, if I'm trading, what was the volatility 15 minutes ago, half an hour ago, an hour ago? That's what's important, volatility related to itself. So what you'll see on the little white volatility dashes, we'll move a little bit back and take an example. We'll use this one right here. In fact, we'll use this whole sequence. So here you have a transition in the slope, change of slope from up to down, right? Inverted U. The slope will always change first. The slope of the cyan momentum algo will always change orientation first. Now, as price was spiking up here, as price went higher, on each bar, the little white volatility dashes got wider. And what that means is volatility obviously is expanding. But here's where we get into that second derivative. As price comes up here and starts to back off a little bit, notice how wide the two white dashes are here. And they get a little bit closer here, and a little bit closer here, and they get very close here. And then right here, and this is the secret sauce, right there where I have the crosshair, just before the little white volatility dashes cross from above to going through that momentum algo, notice they're completely meshed. Now, what does that tell you? that volatility right now at this particular moment where the crosshair is has compressed dramatically from what it was on the way up and what it was at this peak. The entry is when the volatility dashes cross through from above to below. So when the momentum algo transitions from transitions in slope, in this case from going up to going down, that just puts it in the ready state. And when the volatility dashes get as compressed as they're going to get and cross through, that's the short entry. Now you don't have to chase this because almost every time it will give you a second entry, at least one, sometimes several quote unquote second entries. But think about now why that's so powerful. Primarily for a trade to continue in the same direction, you need two things. You need to have momentum on your side. So if you're short, you want momentum to be going lower. If you're long, you want price momentum to be going higher, obviously. But in addition to having momentum on your side, what you want to do is you want to enter the trade at the moment that volatility is about to expand in your favor in the same direction of the momentum, in the same direction you're trading. So at that moment in time, when you get into that trade, it's the precise moment where volatility is compressed the most. And then what happens after this crosses through? Notice how they start expanding again? Now you've got down sloping momentum, momentum's going lower, and you've got volatility expanding in your favor. Incredibly complex mathematically, but very, very simple the way we designed this interface. Now, one of the I say devious in a good way. One of the devious things built into this algorithm is that when you're short, it's designed to allow you to profit from bull traps, from people thinking it's going back up and then they're wrong-footed and then they get stopped out. And when their long stops get taken out, that sell transaction adds additional fuel to the folks that are already short and it takes price lower. And I'll give you an example of a bull trap, and then we'll look at a bear trap. So price came up here to, what's that, about 32.36. What day was this? Was it later? It doesn't matter when it was, just in terms of the dynamics. So you had price peak out at 32.36. The algo triggers here. Now, that was a fast move down. So like I said earlier, you don't chase the algo, you wait for the second opportunity. Well, the second opportunity was this bull trap. So price comes down here to approximately 32.07. And it comes up here, pulls back a little bit, and then spikes higher. So if you're trading and you see that price come down to 32.0708, and then you get this spike bar up to call it 32.21, people are piling in back long because they're thinking the same thing that happened here is happening again right here. But notice price went through the momentum line. Did the momentum algo turn up? Just barely, just slightly. That's not enough to trigger it. But here's the key. Notice as price went higher, and right here, in fact, we'll use this as an example. Take this white bar. You had a low of, we'll call it 32.12. Here, price is 32.18. But what happened to volatility? As price spiked higher, volatility didn't expand, it contracted. All right, see how wide the volatility dashes are there? And then on this move up, they get tinier and tinier and tinier. And here's the beautiful thing. When the algo is short, just prior to the next leg, the volatility dashes will just get really, really tight together, snug right up into the bottom of the momentum algo and not go through. They'll turn around and go down the other way. Because if this was a buy trigger, if this really was a real move, these would have crossed back through. They didn't. So now what happens when price does this? Well, it's going to trigger the stops of the people that got long in here. And that's what takes it down there. Now, these horizontal lines on the chart, we're going to get to this later. because you don't trade off of pivots. Sometimes, you can take positions looking for an early entry based on pivots, but if all you're trading off is pivots, that's not a whole lot of information to base risking your money on. What these horizontal pivots are, is these are algorithmic price points. And what they're used for is not so much for trade entries, although there's times when we do use them that way. But what they are is they're waypoints. Just like on a map, they're waypoints or markers to help you manage the trade, give you algorithmic spots to take incremental profits, and also give you an idea where key levels are so you can put stops above and below them. That's what they're for. You follow the algo, the oscillators, the momentum algo and the volatility metric, and then you use the horizontal price pivots. Now, these are updated every day and at the end of every trade session. So we're going back here and showing you this here. So these horizontal lines aren't going to be relevant. I'll show you the current ones in a minute. So now you get this move down. You hit a high of 32.36. Down here, you hit a low of 32.04. All right. Now, we had a change in the slope of the momentum algo from up to down, inverted U. What did we get here? The opposite, down to up. Now, once again, the momentum algo will change its directional slope before the volatility dashes cross up and through. And so what happens is you get people that now are getting bearish, they're getting scared, and now you get the algo taking advantage of a bear trap. And so it's the same thing in reverse. The momentum algo changes from up to down. That transitional change in slope simply puts the algo into the ready state. There is no trigger until the little white dashes cross over, and note again, they get really compressed. You can see that right here. They're completely meshed together right before they cross through. Now, like I said earlier, you don't have to chase the algo because the second chance entry, I'll show you a couple examples. The second chance entry is when you get a back test up to the momentum algo. So you had this back test up, and the entry, and there's a couple ways you could have done it. You could have entered short when it crossed back through the cyan momentum algo, or you could have picked getting short below the low of the bar that crossed through. So this bar right here, you could have got short right there again, because now you know there's a pretty good chance that this spike up failed, and you already know that the volatility has compressed, and you know that the momentum algo has had this little sideways consolidation and turned back down. So second entries are on the back test to the cyan line. So taking this example here, yeah, you can enter at the open of the bar right after it triggers. And you know that doesn't always give you an ideal entry from a risk reward, because the crossover is right here, and this next bar opens 32.20. So why chase this thing when it had already gone from 32.03 to 32.20? You don't. You wait for the pullback that comes down into the momentum algo. And what's going to happen? This thing went down to 03, comes up to 20. And what is the typical trader going to do when it comes back down here to 32.14? You know, it's a thing called recency bias. They saw what happened here, so they think the same thing's going to happen here, has happened here, and it's going to come down here and test this 32.03 again. Well, it didn't. And when it came down in here, notice that the volatility dashes, they didn't really even get close to the momentum algo this time. Here they came up and they snugged right up into it. Well, here they didn't even get close. They were on an upward trajectory the whole time. There's a big time bear trap right here. So that was your second entry. right here was your third entry opportunity. And then after that, it's gone. Because at that point, you've created a bull trap or a bear trap here, a second bear trap here, plus anybody who still had stops above this bar or this bar, they all got run and boom. And there you go. Now, let's take the next one. Now, these algo regression lines that we have are one of the coolest things that we've ever done. Because what happens in algo regression lines, these things go back months. And, you know, people tend to go back and look at price levels and then draw horizontal lines as support and resistance. That's not the way this works. You have to factor time into price. Support and resistance isn't just based on price. If it was, then it'd be real easy to trade. All you would do is draw a line at the top and draw a line at the bottom, and that's it. But you notice all these regression lines are either angled upwards or downwards. So you can take, you want to see something cool. You take this line here, that dashed one, let's go back. Oh, what do we have here? There's a top. Let's take it back some more. There's another top at the regression line. Let's take it back some more. Now, with the regression lines, when they're pierced and it goes the other way, you know, you get these powerful reversals. In this case, you came down, came above it, and we're looking at this dashed one, and then down again. But you see how far this thing goes back? I can keep going and going and going. And you see how many times that was the pivotal price level. I mean, over and over and over again. It just never ends. So the regression lines are just one of the metrics that we give you. So let's go back to where we were just to finish the thought. So now we come up here. This daily bull bear pivot. In fact, let me go over here and, oops, wrong thing. Let's take this one. All right, to give you an idea and to prove once again that there are specific time cycles, what you see on the screen is what we call our Mercury dynamic pivots. This is a set of algos that get run over an hour and a half before the day session starts. So if you're on East Coast time, market opens day session at 9:30. These are run prior to 8 o'clock. Now, it takes a while to get all of this, get all these things done, so they're posted for members around 9 o'clock. But the very first thing we do after these things are run is I publish on our Slack channel, which is part of our member package, the daily bull bear pivot for ES, the S&P 500, and NQ. So here you have the 29th, which was Wednesday. Every single day, the daily bull bear pivot is the single most important price on the board. And I'll show you examples of it. And it's real simple. If price is underneath the bull bear pivot, you're long above, short below, period, end of story. And so in addition to the algorithms, the automated algorithm that I showed you, you've also got these fixed prices that are on the chart. And here's the thing. If this service did nothing more than give you the daily algo bull bear pivot, it would be worth 10 times, 100 times more than we charge. Because you literally could make 100 times more than we charge you if that's all you do, is get long above the daily bull bear pivot and short below with a stop on the other side of it. That's it. Now, I got to be real careful when I say make you a lot of money. So this is a good time for the disclaimer. Futures trading involves significant risk. You can lose more than your initial investment. Futures trading is not suitable for all investors. It's up to you to do your homework to see if futures trading is appropriate for your account, risk, financial situation and where you are in your life. All right, so disclaimer, which I was supposed to do at the beginning. Now, look, when we publish these dynamic pivots, doesn't mean you put 30 different horizontal lines on your chart. I do that for you because every day after these are all done, there's typically 4 to 6 of them that go on there, but we always put the bull bear pivot on there. Now, as you read this chart, the lower you go from top to bottom, the progressively longer the time cycles are that generate that level. So as you go down in price, they become more important because they're longer time cycles. At 10 o'clock in the morning, we calculate, I say we, I don't like using the word I, so I've had this habit since I was a kid that instead of I say we. So just so you know, when I say we, it means Mark Anthony. But at 10 o'clock every day, I do the X5 institutional pivot. That is, other than the daily bull bear pivot, that's the most important number to institutions. Now, not necessarily institutional algos, because they make decisions based on a lot of different metrics, but the institutions that just come into the day and say, this is a level we're either going to defend or we're going to sell into, that's it. And I'm going to show you a reason why we had that sharp sell-off on Friday in the morning and why it went where it went. In fact, so that I don't forget, let me do that right now. All right, so here's the dynamic pivots for that were released pre-open on Friday. Now, one of the things that we saw all week is that there were these tremendous clusters. I remember on Wednesday and Tuesday, Wednesday, Thursday, there were 12 pivots, excluding the X5 pivots, just on the basic set of algos we run. Tuesday, Wednesday, Thursday, there were over 10, and I think 2 days there were 12 algo levels between the price of 32.20 and 32.30. So if you've got all that magnetism algorithmically between 32.20 and 32.30, well, now you know why every time it runs up to 60 or 70 or mid 50s, it gets sold into, and every time it goes below that chunk of price between 32.30 and 32.20, every time it goes below that, around 3,200 or a little bit lower, it, you know, like a trying to hold a beach ball under the water, it pops back up. But the reason I'm showing you this is notice that we've got 4 tick pivots, and I have never seen this before. These 4 are the longest ones. These are really long tick pivots. And what blew me away when I ran this is all 4 of them are within less than 2 handles. 1746, 1970. I've never seen that before. And that's why price keeps going back down into those levels. Now here you have our X5 pivot. Now the reason I called them X5 pivots is because I found in the back testing and the amount of back testing I do to make sure this stuff works is ridiculous. I work 18-hour days, not every day, typically 16 hours is a normal day, but Tuesday, Wednesday, Thursday was 5 a.m. to 11:30 p.m. with 0 breaks. I've had ADD since I was a kid. I don't, you know, that's just the way I'm wired. And not to get off the subject, but for probably 10, 15 years, my doctor's given me Ambien to sleep at night. If I take an Ambien at 11, I'm still wide awake at 2 o'clock. So I only get I'm one of those weirdos that only gets a couple hours of sleep. And the reason I'm bringing that up is I provide so much content for y'all, it's insane. I mean, it's just constant all day long. But back to the point, the X5 pivots, the reason I called them X5 pivots after it was developed, because what I found is that they're relevant for 5 days. Now, this too is something I've never seen before. you had the X5 pivots for the 27th, 28th, 29th, and 30th between two handles. So you got this cluster of institutional pivots within two handles between 32.20 and 22. And you've got four super long cycle tick pivots between two handles between 19 and 17. So there's a reason that Thursday night in Globex, I shorted at 32.68. And I did that twice. I shorted it, took profits on it, adjusted my stop, it went up and took my stop, and shorted it a second time. I normally trade a 4 lot of the E-mini, and I'll show you our Slack channel because you can see where all the trade alerts are posted. I mean, it was over 100 handles between Globex Thursday night and Friday, and that does not include that goofy ramp that we had Friday afternoon. That was literally 125 handles between Globex and lunchtime on Friday. All right, but because of the volatility in this market, I mean, you can trade this market with very modest account as long as you have proper risk management. Now, I'm not telling you that if your account only allows you to trade a couple of micros, that you should be trading futures at all. That's not what I'm telling you. But what I'm saying is the amount of volatility, the price movement in this tape, you know, you can make a profit with keeping position sizes very small. So let's get back to the regular scheduled programming here. So you're starting to get the idea here. You come up here and you get the peak in the momentum algo, the cyan line, and it starts to roll over. Now, what I like is the entries in the algo where it's much more gradual, where you're not getting this spiky stuff where you have to wait for a second entry. So here you get a nice gradual turn. And right in here is where the volatility metric peaked. And here's your bull trap, and then it goes lower. And here's the second move back into the momentum algo. That's the second bull trap. This is the third bull trap. This one was nasty because a lot of times when the algo is locked in, you'll just see a single bar that either back tests up into it, or in the event that it's long, checks back, you know, down into a rising momentum algo. But the reason you got this strong move from here down to here is you didn't just get one bar of a bull trap. You had 1, 2, 3, 4, 5. Well, 5 times 12 minutes is an hour. You had an hour's worth of traders that got trapped when that broke. Okay. And then what happens? Where did the strong move originate? Where you had the break of the algo regression line and the recapture. You break these, and then and I don't mean just recapture it by a couple handles. I mean, when you get price acceptance in the opposite direction, you better get out of the way because you're going to get a big move. So I'll just show you a couple more, and then we're going to move on because I'm supposed to keep these to an hour, but there's no way we're going to be done in 15 minutes. So here you have long entry. Now again, you don't chase it. You wait for that pullback. Now notice what we have coming in here. This purple line is a really long cycle algo, and it's such a long cycle that a lot of days it doesn't even come into play. Well, right now it's right in the heart of the chart because this tape is trying to figure out whether the next 50 to 100 handles are higher or lower. And so what you do is, again, you simply wait, and the accuracy of these metrics, I mean, literally you had a pullback there and there to the tick, and then it goes. And then you had a pullback almost to the tick to the momentum algo, and it goes. Now, when you see the momentum algo with a very aggressively, not aggressively, a very aggressive slope up or down, those pullbacks, right after the pullback, they're going to run. And that's what happened here. So now, is this, are we now into Friday? Okay, so now we're into Friday. Let me make that a little smaller. All right. Now, the reason price keeps getting rejected, there's many reasons, but the reason price keeps getting rejected when it gets up here above 3260 is now you've got both of these regression lines here. So it came up once, came up a second time, came up a third time, and that was all she wrote. So the algo triggered right in here about 3259, 3260. We'll be conservative and say it was 59. I was short at 68. When we had this first move down and then we had this move back up, that's all I needed to see. And by the way, you notice this green bar and this red bar, and then you have this little one up here. It looks like inverted goalposts. When you see that, that's usually going to be a high. When you see something that looks like regular goalpost at the bottom, price will do the opposite. You'll see that on some algorithmic time frames. It's just one of the things I teach you to look for. Now, how many second chance entries did you have here? So, you know, I put the short out on the trade alert for our members on our Slack channel, 3268. And I took profits incrementally as it went down here. And then I put my stop above this price level. 3260.75 is a big, big level. I'll show you why in a minute. But I had my stop above that, as the tape will often do. It took out my stop, went like another handle or two, and then I got short again. So you had your short entry here. You had this move back, and this one, I knew this was going to be it for the night, because it came back into the confluence of this regression line and this vector. Now, these vectors are really cool. Here's what a vector is, because if I don't show this to you now, I'll forget to do it. What chart do we have here? It's hard to tell by the thumbnail, so let's see. Is it this one? Nope. Nope. I'm going to show you these charts here that I'm clicking on in a minute. This is why I don't like having static canned. Come on, you knucklehead, where is it? That's not what I'm looking for. If it's not here, I'll open it in just a second. I can't believe I don't have that here. All right, this is the one. These algos are so sophisticated, you can literally trade off third and fourth derivatives. So this is an example of the oscillators that are available. We put a couple oscillators on the main live chart. So this is the 12-minute day trading cycle. This is a 27-minute cycle. Now, the fact that I'm telling you that 27 minutes is an important time cycle is more than 99% of system developers will ever tell you before you subscribe. And I'm telling you that now, because whether you subscribe or not, I want you to remember that. All right. Now, while I'm on this screen, this is the day trading cycle with the day trading algo. This is the swing trading cycle. It's 27 minutes. This purple pivot on our swing trade cycle, I call it the matrix pivot. That's what we call it in our service. That's how the members know it. Because the purple pivot on this top left chart, that is literally the epicenter that all the other algorithms revolve around. Oops, didn't mean to do that. If you've ever seen a cutaway of a Nautilus shell, and you look at that very center innermost chamber, and they all spiral out around them, That's this. Now, one of the cardinal rules in our system, let me get back to where I was. I messed it up when I clicked on it just like that. All right. Is this all the way forward? There it is. All right. One of the cardinal rules in our system is always know where the matrix pivot is. Because the rule is real simple. When price is below the matrix pivot, you only have two choices. Either you're short or you're flat, period. When price gets acceptance above, and I don't mean just pokes its little head a couple ticks above, when you get price acceptance above the matrix pivot, you got two choices. You're either long or you're flat. Now, every once in a while, we will take counter trend trades just based on price moving into very, very key levels like I did on Thursday evening. But generally speaking, you're long above and short below. And you can see what happened here at the end of the day. You come down here into 203. Give me just a minute. My daughter walked into my office and walked out without closing the door. See, my teenage daughters should know that when I'm sitting here in my office talking, I'm not talking to myself. We're doing a webinar. And they're not smart enough to shut the door on the way out. So we don't want you to hear dogs barking and such. So you had this strong move down on Friday. And on this bar and this bar, it came right up into the matrix pivot. And this one, it broke. And then boom. Now, there's a very high probability that this nonsense at the end of the day was smoke and mirrors, because if you were watching your screen on Friday, I can tell you, and you probably noticed this, that your screen was flickering a whole lot faster on the way down than it was on the way up at the end of the day. In our proprietary tick algorithms, absolutely show that that's the case. And if I forget, remind me at the very end of this, if I don't remember to do it. I'm going to show you a chart of the dollar index. The folks that are buying here at the top, I hope it works out for them, but the dollar index has a different opinion, because we may have had a very, very significant key reversal from down to up in the dollar index on Friday. I'll show you that chart in a minute. Now, I was talking about the importance of the daily bull bear pivot. It's up here at 3253.20. Again, that's produced before the market opens. Even though that data sheet with all the pivots on it, even though that comes out around 9-ish, the very first thing I do in the morning is I run the algo for the daily bull bear pivot and post it on Slack. So that's usually up there before 8 o'clock. But notice what happens. You lost it, you had a fast move down. Now, it came down here to what, 32.12? Well, who in the world thought that, you know, you could have made money buying 32.54 late in the day? Now, that was 351. I mean, that's not, you know, it's very, very seldom we do business trading that late in the day. But, you know, when it came back and it reclaimed the daily bull bear pivot at 53, the silly thing ran 16 more handles. That's how powerful the daily bull bear pivot is. Now, one other thing I want to mention here before I forget. Purple pivot here, top left chart, 27-minute cycle. This is our swing trade cycle. That's the matrix pivot. What you see down here is the matrix pivot on a cycle that's over 2 hours per bar. This is the intermediate pivot. It's the long cycle version of this. And so notice, this is what I was talking about with goalposts, by the way. So notice, and you only have a couple of these bars during each day session, but notice what happened when it lost the intermediate pivot, which at the time was synced up right with the daily bull bear pivot. Yeah, that sharp move down. Notice what happened when it crossed it, which was, call it 32.47. Boom. Now, with this move up that we've had over the last couple months, the tendency is that ES does not like to trade below this intermediate cycle purple pivot that often. And when it reclaims it, it runs. We saw a distinct change in character this week, Wednesday and Thursday. You know, then when you had Apple, Amazon, Facebook, and Google report after the close Thursday, you know, then everybody was stumbling over each other to buy Apple above 400, and that you know, if they did that Thursday night, or you know, they worked out for them. But here's the problem: July is a seasonally bullish month. Do you think that there was a coincidence that Apple, Amazon, Facebook, and Google, for the first time, reported on the same day going into the last day of July? I'm telling you that what you saw on Friday is very, very unlikely to continue in August. And if they do get a stimulus bill and pass it, right after they pass it, you know, it may take half an hour, whatever, for all the short squeezing but I guarantee you there is going to be a big time sell the news opportunity if they do pass an extension of the stimulus. And it's going to be no different than the sell the news event that you had when they finally agreed to the China deal. Anyway, back to the subject. A couple of other metrics here we've on the main live chart, and I'll take a couple minutes and show you the live chart too as well. Here you've got the S&P 500 advanced decline line with some of our oscillators on it, and you use the oscillators here no differently. So this was Friday. Advanced decline line was putrid all day, but the high in the morning was right at this white dashed oscillator. And you see at the end of the day, once you had price acceptance above it, which occurred about 248, 250, here's that time frame on the chart. Boom. So the oscillator, you don't trade off of these, but it's one of those things that give you confirmation that something has changed. Now this is pretty cool. I don't know if y'all have seen this. The VXX, what the VXX is it's the volatility metric specific to ES. So whereas the VIX is the volatility metric for the broader market, the VXX is specific to ES. Now, like typical volatility metrics, there's an inverse relationship. So if ES price is going down, the VXX is going up. If ES price is going up, the VXX is going down. Well, notice the little minus sign. What we have down here on this panel is the inverted VXX running on a very short time cycle, 4 minutes. And the reason I've got it inverted is because all we're looking at with this chart is to see if there's a divergence. So by having it inverse, that means that this should be going up when ES is going up, and this should be going down when ES is going down. And we've got this on a very fast cycle, 4 minutes. And you don't take action off 1 or 2 bars. What you're looking is for a divergence over 20, 30 minutes. And that's what you got at the high. And that's what gave you that last move down. The VXX but the VXX runs until 8 o'clock at night. And then you don't see it for the rest of the evening. Now this is interesting over here because what we did was we took just a simple Bollinger Band, 5-minute Bollinger Band, okay? A lot of traders use that. But again, like I said earlier, 5 minutes is not an algorithmic cycle. So I put an algo on here. There's 2 pieces of it. You've got a white dash and a purple dash. And it could not be any easier to interpret this. Think of the purple as the baseline. When white is above purple, the algorithmic momentum is upward. When white is below purple, the opposite, the momentum is downward. So let me zoom in on that, and I'll take you back a little bit. And so you can see they get kind of squashed together here, price breaks, and they start expanding because this is a volatility metric as well. On each of these bars, white is below purple. So it gives you a whole lot more to go on than just a typical 5-minute Bollinger Band, because sometimes on a 5-minute Bollinger Band, you'll get these moves up that'll reverse. Now this one, when it crossed from below to above, this is 5 minutes, so 1, 2, 3, 4, 5, 6, 7, 8. So you had 40 minutes before it reversed down. But there are times when you'll get a little poke up above the Bollinger Band like this, and then it reverses, and then you're trapped. So that's why we've got this on here. If you're the kind of trader that likes to trade off 5-minute charts, or you're used to trading off Bollinger Bands, that's what this is here for. Now, the other reason, the other way you use these white and purple dashes is so that you don't go out of don't get out of a profitable trade too soon. So you had the crossover right here in price. You didn't have confirmation that the momentum had switched to upward until you have this bar where the white's above the purple. But if it came up into here and you're thinking, all right, well, you know what, I got in down here, I'm going to take profits up here. It would have been prudent to take a partial profit if you had multiple contracts on, but there's no reason to get out of it completely. And there's no reason to get out of it here either. You see how powerfully price momentum was moving upward because of how wide this spacing was. So there was no reason to get out of it. And when it went sideways here, there's no reason to get out of it. As long as that white is comfortably above the purple, let it ride it out. That's what that's there for. Let me show you. I'm going to switch this to live chart 2. And actually, before I do that, the reason I've got ES, the continuous contract here, and the front month contract here is because it allows me to put different sets of pivots on here, different metrics. So the daily bull bear pivot always shows on both of them. The X5 pivots are always here. If the chart's not too congested, I'll put them over here too. But the pivots that have the funky names, like trend confirmation pivot, backtest pivot, tick extension pivot, those come from the Mercury dynamic pivots I run in the morning, okay? The Mercury bands, those are run in the evening before Globex opens. And we've had several inquiries from institutions to buy that metric. Not happening. I'm about as blue collar a guy as you get. That's the way I was raised. I'm just a redneck from Florida, pushing 60 years old. I mean, I've been told I sound like I'm younger. I guess that's a compliment. You know, childlike, not childish, I suppose. Although that's debatable if you ask my wife. But the Mercury bands are different from the dynamic pivots. These are run in the morning, okay? The Mercury bands, which you see over here on the swing trade chart, those are run at night. Now I have to wait until we get the full daily close, not the 4:15 close, but I have to wait till 5 o'clock. And then I run those between 5 and 6. They take about an hour. Most nights they're posted before Globex opens. Sometimes it's a little bit longer, but those are posted for the Globex open. And the way it works for members, this live chart you see, all you need is a free Zoom account. You can get a free Zoom account. just with your email. And then every night between 5 and 6, I give you a new passcode. The passcode's posted on our Slack channel, and I also email it out to you before 6 o'clock. That runs for 23 hours. So once that new code starts, when Globex opens at 6 o'clock p.m. Eastern, that's the only code you need until 5 o'clock the next afternoon. And then I give you a new code between 5 and 6 the following day. Now, if you want to be able to see both live charts at the same time, Zoom won't let you have 2 meetings open at the same time on a free account. So, you know, the workaround is if you have 2 separate email addresses, say an Outlook and a Gmail, you just set up 2 different free Zoom accounts with 2 different emails. And now you got 2 free ones, and you can have them both on your computer. Or if you have multiple computers like I do, have one. I mean, I've got 3 computers on my desk. I've got live chart main that you're looking at to the left of me. I've got live chart 2 to the right of me. And then I've got another screen that's got my personal live chart, which has a whole different set. So while the market's trading, I'm looking at additional stuff to help you out with. And on Zoom, I'm on the mic quite frequently throughout the day. I try not to sit there and babble, but only get on there when there's something important to talk about. But I'm on the live chart on the mic quite frequently throughout the day. I don't get on the mic too much in the evening, but any trade alerts I post are on the trade alert section of the Slack channel. Let's take a look. Let me pull this out a little bit. These Mercury bands are, I can't tell you how many times that the Globex high came within 2 ticks of a Mercury band. And the way the Mercury bands are constructed, let me show you how that works. Yeah, that's the NQ one. I don't want that. This one. Okay, so this is an example of the actual data sheet. Now, what happens after I run these, I overlay the levels on the chart, and then I post this data sheet on the Slack channel. So you can open this, print it out. The way the Mercury bands are constructed, here you have the body of them. There's short cycle and long cycle. And for each cycle, you have an upper, think of a metaphor of a Bollinger Band. Bollinger Band, you have the mid band, upper band, lower band. Well, this is kind of that same metaphor with the added metric that you got an upper level, a lower level, and you have 2 mid levels. And none of them are any more important than the other. The long cycle Mercury bands can sometimes be more powerful, but they're all important. Now, the long cycle is an algorithm that looks back at 10 days of time price data. 10 days on the long cycle, 5 on the short cycle. Now, what these Mercury bands are designed to do is 3 things. Notice none of my charts have volume. None. Never look at it. Never, never, never. I don't need to. Because what these Mercury bands do is they find what are called HVNs. Now that acronym, some people call it a high value node. Some people call it a high volume node. Same thing. It's just a pivotal price where a lot of inventory was auctioned, okay? Because look, all the market is an auction mechanism. And so what the Mercury bands look for is 3 things. They look for areas that are significant resistance, significant support, or they cut right through very, very important congestion zones. And I'll show you what I'm talking about. Now, I've got a lot of labels on here. One of my things I got to do each weekend is take some of these labels off. I put these labels on here to take screenshots for you. But let's just take this Mercury band right here at 25. And again, the Mercury bands are designed to find resistance support levels like here, support level, resistance level, or they will cut directly through price. Now you just take this one here at 32.25. How many times has that been fought over? Here, 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 and we can keep going back on the chart. But that's why these things are so powerful. And I'll tell you one thing, at the end, when it gets late in the day, as an example, when it gets late in the day and price goes up and through these Mercury, you got to get out of the way. Because there's a lot of times during the day session where price will come right up to it and reverse. It does here, it consolidated and then it went. So this is an example right here. This was what, end of the day Thursday? So if price comes up and it consolidates, or it keeps finding resistance at one of these Mercury bands and then it goes through, you got to get out of the way. Because what that tells you is all that inventory has been properly and fully re-auctioned. And if it goes above it, there's no more stops to chew through. They're gone. Stops are gone, and now boom. And that it works that way in both directions. So I want to show you some of those screenshots, but before I do that, let me switch this over to the second live chart. This one you're looking at is way more is the more important of the two. So if you only have the ability to look at one, you want to be on the main live chart, because again, you've got the automated algo right here. If you like to trade off Bollinger Bands, we have our algo metric overlaid on the 5-minute band. You've got the oscillators on a 12-minute cycle and a 27-minute cycle. 27 minutes is the swing trade cycle. You got your matrix pivot right here. You've got your long cycle matrix pivot over 2 hours per bar here with your VXX and your 80. So this is the one you want to be if you only have the ability to look at one. But let's take a look at the other one. And I've got it open on my other computer to make sure I'm doing that. It's that one there, okay. So once this all loads, we'll put a little bit of distance in there. And here we've got Apple and Microsoft. So what you got here is you've got the algorithmic oscillators, 12-minute cycle, 27-minute cycle. This is the one that's over 2 hours, and this one's over 4 hours. Up here, you've got NQ, and because it trades over 10,000. I've got this on the longer cycle, the swing cycle, 27 minutes. But how powerful are the Mercury bands? You failed 3 times. Thursday, beginning of Globex, right there. Perfect. Late Thursday night, little tiny poke above and a failure. Friday morning, they sold the tar out of it when it came up here again. So again, I mentioned earlier that the idea is to follow the algo. If it's long, be long. If it's short, be short. But we do play reversals. When I originally started training, I was trained as a short seller. So there is nobody that can short the market like I can. And I love taking these kind of counter trend moves when the algorithmic data shows that it's a high probability. And look, you have to trade in the direction of the flow. You not want to be in there shorting. And here's the difference. There's a big difference between taking a high probability counter trend short versus being stubborn short. This is a high probability short right here. It's already come up here twice. So This is a high probability change of direction play. You just have a stop a little bit above the Mercury band. But there's a big difference between taking a high probability quantifiable risk counter trend short versus being stubborn short. This is stubborn short. Stubborn short is, it comes up to this Mercury band and it pokes its head a little bit higher, and you decide on this bar, okay, I'm going to see if we get a reversal. I'm going to get short right here with a stop above it. And then it comes up above it and you say, well, I'm going to give it another minute. I'm going to raise my stop, raise my stop, raise my stop, raise my stop. There's a big, big difference. And this is the point. There's a big difference between taking a high probability potential risk reversal entry versus being stubborn short. So there's a lot of folks that have the attitude or the misconception that people that do a lot of shorting are gamblers. Look, this game is about probability and risk reward. Gambling doesn't work. You want to gamble in this market, and I don't mean to be crass, but there is a direct funnel from folks that are taking their stimulus checks and speculating in the market. You know, you go from taking the stimulus check to using your stimulus check to gamble in the market to going bankrupt. That's not what we're talking about here. So this is what you see on the second live chart. So let's review some of these screenshots that I prepared so I can wrap this up. We're already over an hour. Start from the beginning, and I'm not sure what order these are in. This kind of thing we looked at before. You can see the algo trigger short here, long here, short here. Now, here's something else that's interesting. Here you had the algo start to get long. Now, 2 points. If it's long, it's not going to flip short at a less favorable price than where you got long. In other words, it's not going to get you long at this price and then find out down here it was wrong and flip you short. And there are a lot of systems that will do that. They'll take a loss before they figure out they were wrong. This system does not do that. Period. But there are times when you get what I call a fast flip. And that's what you had here. You had a long trigger here, and a couple hours later, it went short. Now, it shorted at a higher price, okay? So it didn't wait to find out price was lower to flip. But here's the thing, and I mentioned this at the time when it started to, as soon as the momentum algo peaked here, I said on the mic to our subscribers, be real careful because this is setting up for a fast flip. And what I define as a fast flip, it's when the automated algo flips either long to short or short to long within just a couple hours. Because when it does that, it gets really violent in that second direction. So here we had a fast flip from long to short over just a couple hours, and that got nasty in a hurry. You know, you were up here at, what is that, just under 40, and boom, you're testing the roundie in no time. Now, as a practical matter, as a logical matter, why is that? Well, because it catches a lot of people the wrong way, okay? When you get a fast flip, in this case from long to short, you had a big time short squeeze, big time. And that's what you get. And it's no different if it's short and within a couple hours it flips long. You have to get out of the way, either ride those or get out of the way, because those are the ones that get nasty. And we made a really nice lick on this one. All right. Let's see, next one. Well, we'll go through these pretty quickly. This is the chart I was looking for before. Except in rare instances, I color code the Mercury algo regression lines with the color tan. Now, we're looking at these charts in Thinkorswim. If you go into Thinkorswim and go into the pre-canned data sets, they've got a regression line. I'm not picking on Thinkorswim here. Thinkorswim's an awesome charting package. But the canned indicators they give you, I have no idea how they calculate regression lines. The way that I do it, it is a formula based on time and price. And look, time doesn't go backwards, right? So when you take these regression lines, most of them will have an angle upwards. I do have ones that are downward, but what I define as a vector is a point at which two regression lines, upward and downward, intersect. Now, each of these regression lines is based on a specific time frame. The reason this one doesn't look like it intersects is because when I took this screenshot, I actually had the chart on a different time frame than what was used to calculate these Mercury bands. But this level is the right level, 62.75. I mean, how many times is this thing going to fight over that? And then here you have another vector right here at 40. How many times is it going to fight over that? Now, again, these regression lines have two different types of characteristic behavior when price comes into them. There are times when they will repel price in the other direction almost to the tick. This one sent it back higher. Where is it? This one sent it back lower. And there are other times where price will fight over it, like it did here. Like it did here. And then eventually release. So when you see price fighting over these regression lines and it releases, whatever direction it releases, you'll typically get a strong move. But these vectors, these are the battle lines that the market is trying to resolve, these vectors, because this is literally a fourth derivative algorithm. The oscillators are a second derivative, and then what I take is the slope of, is it this one? You've got another derivative, which is the slope. So here you've got two algos, algorithmic oscillators. These are not, this isn't just throwing an exponential moving average on a chart. You can do some things with crossovers of those things, but when these algorithmic oscillators cross over, they're important. So you take this spot here where it crosses over. Well, where did it fail? Same place, right here. Crossover right there, same thing. But the purple is the fastest one, and then as they get increasingly slower, this is the fast one. Then going from shortest, i.e. fastest to longest, purple, dashed white, solid white. The orange ones are the trend oscillators. Notice how slow these move? The purple one, now this little purple one, is one of my babies. We've got 4 kids, so I mean, I say babies in jest. What the purple one is it's what I call an acceleration oscillator. Because what you get is when price has to travel a long way to get into it, like here it had to go a long way to get from here up to here, you'll get a pullback. You'll get a back test. But when price goes through, when it finally gets through them, boom. Now, when you start, and there are other times after those levels have been tested enough where it will just go through like that. And the reason that you had this strong move down here is, you had people that were caught. This here is what I call an algo hook. What the algos are doing here is simply running stops, and then they reverse. And then all the people that were, let's say they were short here or short here, well, they got their stop run when it went up here. And what the algos will do, the institutional algos will run those stops of the people that are short. And then the hook is they turn around and take it the other way. And all these people are like, dang, I was short here. Now they're trying to chase it lower to re-enter short. It's exactly how this works. Now, here's another example where you had a crossover. The fast oscillator crossed through this one. So notice where that level is. And this is what, NASDAQ? 10,660. And so when you look at these oscillators, it's important to keep in mind points where they cross through, because when price comes back up to them, if it doesn't respect that, it's going right through. You see this cross right here? We'll notice what happened when it came back up and through there, it's gone. I'll give you another example right here. You can see where the white crosses through, or the purple crosses through the solid white. Right there, call it 46. What happened when it got price acceptance back above 46? See ya. So that's how those work. Real quickly, these last couple. The Mercury bands for ES. Let me get a drink of water. Hang on just a second. I speak at a rate of about 200 words a minute with gusts up to about 600. I forget who said that. Anyway, the Mercury bands for ES, for the S&P 500, those are recalculated every night prior to the Globex Open. On NQ, they're only done once a week. Because if I did them every night, then you'd have levels every couple handles, and you can't trade that way. The only time I have to recalculate the NQ Mercury bands during the week is when it gets close to going through the uppermost level or the lowermost level. But you know, this is something, and I mentioned earlier that we've had multiple institutions inquire about buying this Mercury bands formula. I don't say that in jest. Because here you have Mercury bands for NASDAQ that were calculated Sunday before the market opened. And where did it stop? That was a key level there. Now, it did go a little bit higher than that, but this was the close after Apple reported, right at that uppermost Mercury band. What else do we have? Did I show you that one? Yeah. We do this one. So this is a wider view of the NQ Mercury bands. The reason I wanted to share this with you, really important point. I never, ever, ever manually draw support resistance lines on a chart, ever. But if you look at this chart, you're thinking, man, so, you know, would someone do, just take a ruler and put these on here? Every line on here is a mathematical time price formula that we run, and we just look at what you know, the number that it gives us, we put on the chart. And then after I put them on the chart and you zoom out and look at this, you and I could not put levels on these charts any better. I mean, look at this, there, breakout there, here. I mean, it's all over the chart. So, you know, when I say that there's literally some magic in these algos, there is. But when you take these algo levels and you put them on a chart, like I do, and you pull the chart back, and I literally could run it. I can keep expanding the formula where I could have levels all the way down here, but it's not important. I mean, NQ is not going to move 1,000 points in a day. If it goes from the uppermost level here, at this point it was 10,893 down here. Well, then I recalculate them. Also, this level here, You can go back and look at my Twitter feed. Go back to 7/13. And price was trading right about here. And I posted on Twitter, watch this level at 10,983. It's a very special algo. I call it the XSV3. There's a reason for that, which is not important. Now, when I put an important algo out there, it doesn't mean that we're wrong if it goes above it. What I said was this is a key level, meaning it's an inflection point. Well, what happened when it went above it and it came back and lost it? So this is 10,983. You got to move after that down to below 10,400. I mean, you literally had a 600 handle move in NQ based on, and when you see these XSV, there's XSV 2, 3, and 4. When you see one of these XSV pivots on a chart, I mean, you know, I don't know if any of y'all trade NQ, but okay, it was a 600 handle move. Let's say you booked 300 handles of it on a one lot. $20 a handle on NQ. That was a 600 handle move. Now, you know, if you only had a one lot and you had the patience to let it run 300 handles, well, actually, you didn't need much patience. That was pretty nasty. But that's, and let me just say this also. If your account is large enough, you want to trade in a number of contracts divisible by 3. Now, if your account's not large enough, you don't do that. But whether it be 3 E-minis or 3 micros, here's why you do that. Because when you're in a trade, the first order of business is to get as much risk out of that trade as possible as soon as possible. So what happens is once that trade, typically the way I do it is once that trade is 3 or 4 handles to the good, profitable, and if the probabilities are less favorable or it's a counter trend trade we're taking, then I'll take that first third at 3 handles. But the point is, if you're trading something divisible by 3, it allows you to take your first third of profit very soon. And then after that, you look for a spot to take your middle. That's where you're looking to take profit on that middle third. And a lot of times what we do is after you take that first third out, oftentimes we'll adjust the stop and make it tighter. Now in this market, a lot of times you have to give it a little more room because if you're in a trade at, we'll just use a round number. Let's say you're in a trade at 3,200 long and it goes up to 3,203. And let's say your stop was at, you were long at 3,200 with a stop at 98 or 97. Well, it doesn't take much for that to go up to 3,203 and go back down and take your stop. So now in the old days when the VIX was 13, 14, 10, 12, 13, 14, 15, the way we traded back then is when we got the first 2 or 3 handles out, whenever we took that first third, we'd go even stop immediately. By even stop, I mean move your stop to the price that you got in. So back in those days, to use that same example, if you were long, for example, at 3,200 and it hit 3,203, you would take that first third out and move your stop to where you entered at 3,200. So this tape, it's harder to do that. But absolutely, as soon as you get your middle out of it, or as soon as it's 6, 7 handles to the good, then we either put it at even stop or give it 1 extra handle, and that's it. So the whole thing about taking a +3 is this. It's about the mathematics of trade management. If you got a 3 lot and you take a +3 on the first third and you move your stop to 1 handle underneath where you got in, well, you've locked in a profit of at least a handle. So if you're long at 3,200 with a stop at say 31.97, it goes up to 32.03, and you take a 3-handle profit on that on that first third. And then let's say you don't go even stop at 3,200. Let's say you want to give it an extra handle. You put the stop at 31.99. So if you get stopped out, that means you took a profit of 3 handles on one contract, and on the other 2/3, those other 2 contracts, you lost a handle, which means you made 3, you lost 2, you still made a handle. Now, if your account's big enough, I like trading in a 4 lot, and I'll tell you why. Because after I take that middle, it gives me 2 to work with. Because one of the things that drives me nuts is if the market is running in your favor, higher or lower, and you only have 1 contract left, that last third, the runner is what we call the last third. If the market's running and the trade's going really well, the one thing I hate about trading is trying to decide, okay, do I take my profit here or do I let it go? I hate that. It drives me bonkers. And it had driven me crazy for a long time. And then I finally said, genius, why don't you just put an extra contract on? So you take your first third, that 1 contract. Now, I know if you're trading a 4 lot, taking profit on 1 is not a third. But what you're doing is you're trading in thirds plus 1. So you take 1, if you're trading a 4 lot, you take your first quote unquote third, you take 1 of the contracts off. You take your middle, taking 1 of those contracts off. So now instead of being left with a runner of 1, you got 2. So if you get a really nice move, what it allows me to do is what I call split the runner. So a typical trade, in fact, I'll show you one here in a minute, but you know, you could take 3 on the first one, and then you get 6 or 7 on the second one, and then let's say it runs another 10 handles in your favor. Well, I don't have to figure out, okay, do I take profit on the last one here? Is it going to keep running in the same direction, or is it going to reverse? If I got 2 left, I split the runner, take profit on 1, I still have 1 left. All right. And I need to wrap this up soon, or we're going to go way over the limit. I mean, I can go 23 hours on Zoom. I can do a 23-hour meeting, but I don't think you want to do that. Let me see if there's anything else that I didn't show you. Anytime you see 2 Mercury bands at the same level, here you got a Mercury band at 57, what, 57.91, and then you had this other metric just right above it, about a tick above it. Anytime you see 2 of them at one level, those are going to be important. So it came up here twice and failed, and then when it came up here again, this is where you got that hook the other night. So the Slack channel, so these are all the trade alerts. Oh, by the way, the daily bull bear pivot, I give you the info for all these. ES, NQ, SPY. So if you like trading SPY or QQQ options, you got bull bear pivots for all of these, plus the Dow futures, plus the Russell. So what is this? So this is Friday. All right, so here's Thursday night. All right, so 6:52 Thursday night. Short entry at 32.68. Was this the first or the second one? Hang on. This is Thursday. Yeah, that's the morning. Thursday night's the one I want to show you. All right, so here's the short entry at 68. The algo didn't go short until like 59 or 60. So I shorted it at 68, gave it a 3.5 handle stop. And I posted, I may be a bit early on this one, so Keep your trade size small. And I'll always mention that if I think we're getting early or there's more risk or less favorable probability, I manage risk by reducing my position size. And when I feel that way, I note that on here. So short at 68, stop at 71.50. Took +4 on the first third when it had moved down to 64. And what I did at that point is I moved the stop to 69.5, 1.5 handles above. So it was real simple. If I got stopped out, it was going to be maybe, one handle gain or scratch, whatever. All right, so +4 on the first third. Took 7 on the middle, and I had a 4 lot, so I had 2 left. So right now, I had 2 left. I'd booked 11 handles. If I get stopped out for a handle and a half loss, that's a -3. So made 11, lost 3, net gain of 8 handles. Okay. It moved down lower, and I wanted to keep those 2. I put the stop at even at that point, and it stopped me out. Okay, so I made 11 on that. Very, not too long after that, shorted it again at 68. Now, this one was the one I believe was the one that went. +4 in the first third, +8 on the middle. Then with 2 left, I took profit again, +16 handles when it went down to 52, had 1 left, had the stop at 65, and then I slowly, and by the way, if you join our service, Slack's got this annoying thing that on every one of our sub channels, it says, blah, 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 joined. And it's annoying because we've got subscribers in the UK, in Germany, Netherlands, and Australia. Well, if it's 9 or if it's 11 o'clock in the morning here, it's 11 o'clock at night there, and so you can have these trade alerts pushed to your device. So I always tell our members, don't post anything in the trade alerts because we've got people literally all over the world who are going to get pinged on their cell phone because you're saying, "What's up, Mark?" All right, that trade ended up being 41. Trade was short from 68. All right, so here's the day session. Short at 32.43, +7 on the first, 11 on the middle. What did we end up with that one? 33 on that trade. This is why algos are way smarter than human traders. After that entry short at 43, entered short again at 37, and this is the note. I mean, all this stuff's timestamped. Not thrilled with this trade, especially in front of the lunch window, but the setup is there as a result. It's a small position. I'll look to get risk out of it quickly if possible. +4, +7 on the middle. Took +11 at 26, and I took the thing off at 19. So 40 handles out of it. So it was over 120 handles. Now, on our Slack channel, you got the trade alerts. The main room is Mercury signals, and we've got a chat channel too. But Mercury signals is the main one. So each night when I post, for example, the live chart codes, this is where you see them in the main Mercury signals section. So this is the live chart code for the main one. This is live chart code for, and I email them out to everybody too. When I post charts, I almost always will post them here in the main section, but also we've got this separate channel that says charts data. And again, we ask the members not to post in here only because I want to keep it a clean, contiguous timeline. So if you want to go in here and see every chart in chronological order, you can scroll back and not have to wade through a bunch of "yo, what's up" messages. Okay. We've got a member resources section that's got some really long videos in here. And we've got video updates. I don't, all my videos are on YouTube. I don't bother to put them in here, but you can find all my stuff on YouTube. So we're going to wrap up here in a minute, and then I'll take any questions you have. Where's our web? So if you haven't been to our website, well, you have been to our website, or you couldn't have registered for the webinar. Website's mercurysignals.com. Now, I got to tell you, we do a couple things that are really cool. And by the way, in case I forget, I don't know if I was supposed to show you this at the beginning, and I think I might have forgot. Website, of course, mercurysignals.com. This is my email address, markanthony@mercurysignals.com. And by the way, Anthony is my middle name. And you'll see my last name on any emails you get. It was a legal issue. I own an interest in my father's insurance agency, and I'm not actively involved in it. But because you have to keep very clearly delineated lines between insurance and anything to do with trading or finance, and we are not financial advisors. This is a trading service. So technically it wouldn't matter, but it made me comfortable to completely delineate. So my middle name is Anthony, and that's why you've got Mark Anthony. But you can also reach me on Twitter at MC2085, or search for the name or the company. And last thing real quick, I try and do everything decidedly tilted in the member, in the subscriber's favor. And I'll tell you what I mean. Most trading services bill you monthly. I don't do that. Have you ever subscribed to something? This is almost a rhetorical question because it happened to everybody. You ever subscribed to something and a week later wish you didn't, and then you're stuck paying for a month? So we bill you bi-weekly. Every 14 days you're billed. So if you try out our service and you don't like it, all right, you don't have to, 2 weeks, no big deal. We also don't have any contracts, and we give you a lifetime rate lock at whatever the price was when you joined. So as prices go up, and they will, there was supposed to be a rate increase August 1st. We delayed it because for a number of reasons. One of them is I knew we were going to do this webinar today. And I don't know how soon rates are going to go up, and it doesn't matter. The point is this: whatever rate you subscribe at, that biweekly rate is guaranteed for life. It does not matter what these rates go up to. That's your rate. It does not matter if, say, in the future we split these off into multiple services. You will always have what you signed up for at the same price to infinity or the Lord takes me home, one of those two, period. We will never raise your prices. Now, if you go to the subscription page, you'll see all the rates. And if you do decide that you want to try out our service, when you get to the checkout page where it asks for your name and email address and all that fun stuff, at the bottom left-hand corner, put in the code 40, promo code 40, 40, okay? And that will take $40 off your first bill. It's not $40 off every bill. It's $40 off your first bill. So it's literally $88 for 2 weeks. So you can try out our service for 2 weeks for about 1.5 E-mini handles. E-mini's $50 a handle, right? So for $88, you try out for 2 weeks. It's less than a handle a week to try it out. All right. And there are no contracts, so if you don't like it, you can cancel anytime you want. One of the things that marketers always tell you is not to put too much information on your website, because they tell you the whole purpose of your website, the only purpose of your website is supposed to be to get people to spend money. I don't believe that's the way to do business. I just don't. A lot of people think it is. That's not the way I work. So you could literally spend an entire day looking at all the examples that we put on here, because this thing is bullseye accurate day after day after day. I mean, just right here on the home page, it goes on and on and on and on and on and on and on. We're not even halfway scrolled down. Some other examples, click on chart of the day, and I think I'm a day behind. Yeah, I got to put ones on there for, I try and, I put one or maybe two of the best charts of the day on here. But again, you go through this stuff. The reason we have institutional inquiries regarding if we're willing to sell this stuff, it's not because they want to use it. Although there are some things that literally they do not have. They don't have anything that does what those Mercury bands do, and they don't have anything that does what the regression lines do, because it's a proprietary formula. It's not, nobody does regression lines with the formula I do. And nobody knows how to do those vectors. But something else that's kind of got people scratching their heads is the way that these oscillators will cross, and how those points where they cross are so important. But one of the reasons, among many, that I'm not interested in selling to them is because, except for those couple things that they don't know how to do themselves, they would take this and put it in a drawer. They look, their job is to take your money. And I mean nothing conspiratorial when I say this, but the sooner you figure out that the game is rigged, the better trader you're going to be. And you know, you probably maybe figure that out already. And I don't mean rigged like a street corner, you know, game of craps. When I say rigged, it means those algorithms are designed to create bull traps and bear traps. That's what their algos do. My algos work on the same things theirs do. And so we know, we can see on the chart where those bull traps and bear traps are. The first hour of this video, I showed you how many of them. So, yeah, one other thing I want to point out, market reports, these are not done every weekend, because there's some weekends like this where I just don't have time. But every one that I've ever published is on there. Not one word, chart, or sentence has been modified. Now, if you want to see something really cool, go back here to these first ones. January 5th, January 12th, all about the math on January 15th. Everything that came to pass in February, you'll read right here. I mean, we absolutely nailed it. Go back and read all these. Well, I don't mean read all of them, but go back and read any of these. And you'll find that everything that's been posted on here, we were about a month ahead. I mean, I told everybody that look out in February. You know, there's a reason that the January 15th report was all about the math, that we were seeing numbers, seeing math in the algos that said something is really messed up. And there's the reason that this February 1st report was called Dangerous Cycles. And there's a reason that this one on February 9th was called Calm Before the Storm. And there's a reason on February 15th called Mean Reversion. I've got a weird sense of humor. I've got kind of I love silly British humor. And so when I wrote the article called Mean Reversion, I thought, you know, let's do a double entendre. Instead of mean reversion as in mathematical sense of mean, I searched for a picture of something that looked mean. There's the mean kitty. I love that. Anyhow, so now that you know way more than probably anybody anywhere will tell you about a subscription trading service, because they typically want to get you in because they know it might work, it might not work. There is nothing as consistently accurate available for individual traders. So let me open this up for questions. Anybody have any questions? Anybody? Going once, going twice. All right, so there we go. Go ahead. So yeah, David, I have no idea what happened. That's bizarre. Well, the cool thing is you can use that $40 and you'll save $40. So do this. You got my email. What I'd like you to do, and I think I know what happened, and I'll tell you in just a second. So yeah, just go to subscriptions. When you go to the subscription page, it shows you we're charging $128 every 14 days, every 2 weeks. When I started this, and let me not get off the subject. So you go to this page, and you click right here. And then here on the checkout page, down here where it says coupon, you put in 40. Put 40 in there, and when you go to process, when you hit submit order, it's going to show you it's $88 for 2 weeks. So I don't know what happened, why that didn't work, but where you and do this, shoot me an email. You know what I think the problem was, and I'll try and keep this real brief. My web hosting is on my domain. I'm sorry, my domain is registered on GoDaddy. My website runs on WordPress, and like 60%, 70% of all websites run on WordPress. And when I started the website, I linked together my Mark Anthony at Mercury Signals email. This one, where is it? I didn't link them together. I just made it so that anything I get to receive at Mark Anthony at mercurysignals.com, it automatically forwards it to my personal Outlook account. But I wasn't trying to link them together in the sense. And we had a tech guy try to unlink them. The reason and I found this out after the fact, the reason that that I no longer wanted email that I get at Mercury Signals go into my personal Outlook is because of wanting to keep a delineation between my personal email, because I do own an interest in an insurance agency. And what happened when you tried to subscribe, that was right around the time that this tech guy was trying to fix it, and he couldn't. He could never do that. But I had one of our members who literally sent me, oh my gosh, like a dozen emails over the course of 2 weeks. And then finally, and I don't know why I didn't do this earlier, you can hit me up on the sidebar here on Slack, and it pops right up on my screen. He sends me an email or a Slack message. He said, are you not responding to email? And I literally showed him there was nothing there. So somehow when stuff that was supposed to go to my email, that guy messed something up. But evidently it's all fixed. So do this. Do the subscription thing, and then shoot me an email afterwards, right after you do it. I'll make sure it gets processed properly. I have no idea what happened. It's kind of crazy. Any other questions? No? All right, so if, yeah, I mean, because, you know, I am literally in front of a computer 16, 18 hours a day. Wednesday, Thursday, Friday, I was in front of my screen at 5 or 5:30 a.m. Didn't stop work until 11:30 and took 0 breaks other than to go to the little Cowboys room. So I'm really, really easy to get a hold of. Yeah, if you're looking at 30-minute charts, you're really going to like the way this works, because 30 minutes is very close to this algorithmic time cycle I have to go back to the other chart, but on the main live chart, the 27-minute cycle is what I call the swing trade cycle. But that purple pivot, that is the matrix pivot. So if you're used to looking at 30-minute charts, always be mindful of where that purple pivot is. And you want to be long or flat above and short or flat below. And I can actually take the same oscillators and momentum algos that are on that day trade, and I can put them on the swing trade chart. It's real easy to do. And what's interesting is that whole time up from March, when the Fed started backstopping the bond market, when you would get a long trigger on the swing trade chart, you get big moves up. And when and when it would get locked into a short, boy, I'll tell you, they would not let that thing get locked in for very long, and they would come in and whip it in the other direction. I mean, you see that all day long. They don't want to let this thing break 3,200. And I don't know whether the next move is above 3,300 or below 3,200, and I don't care. We'll go with it either way. But it just reminded me of the chart I wanted to show y'all. Whether the next 50 handles is above 3,300 or below the roundie at 3,200, I don't know. But here's the thing. We've had very erratic behavior. Let's just zoom this out just a smidge. All right, so here you have, this is just Wednesday, Thursday, Friday this week. You know the old adage that the market takes the stairway up and the elevator down? Well, not anymore. Elevator up, elevator down, elevator up, elevator down, elevator up to close the day. Now, and I mentioned to our members on Friday that it would take very little juice for the machines to crank this higher into the close, because who wants to be short, A, going into the weekend in the summer where you got light liquidity, and B, who wants to be short going into the weekend knowing that they might pass some kind of stimulus bill? So it didn't take them a whole lot to do this. Here's the problem. Here's the problem. Did anybody ask the dollar index?
Forgot.
I don't know. I posted this on Twitter about an hour before we started. It's around between 3 and 4. And it shows this in detail. So here's Friday's bull bear pivot in the dollar index. It hit its low basically right at the Globex open. Now, this purple dashed oscillator is the fastest one on here. And then as they get progressively longer, here's the momentum algo. Then you have a couple of intermediate algo. So this is the fastest, then the momentum algo, then the dashed white line, then the solid white line, and then this dashed purple is the trend oscillator. Well, what happened here on Thursday? It tried to get price acceptance above the trend oscillator, and you got one final flush. Well, somebody was buying this thing between 2 and 3 in the morning.
Oh.
And, then you get this move up. So you come above the momentum algo. That was the buy, either right there or on the back test exactly to the momentum algo. It's beautiful. Then you get this extension through the bull bear pivot. It didn't dick her around when it got back to the bull bear pivot.
Yeah,
It said, sorry, pal, boom. Then you get a little pullback that won't come down any further than the fastest oscillator that's trajecting at maybe a 50-degree angle, 55. And then on top of that, you got the momentum algo that it really doesn't matter what metric you use. It can be something as simple as, a simple moving average. But when you get something that's much more sophisticated than that, i.e. what's in this momentum algo, and it comes up at, call it a 45-degree angle, and it takes out both of these white oscillators, which are slower cycles, and closes right at the confluence here. And now you've got price acceptance above algorithmically where the backtest failed the day before. What this tells me is this was your flush, and that's it. You know, and it could be wrong, but it's already traded back above this the next day. And it is not too often at all that you'll see this thing or any instrument get rejected to this degree at the trend oscillator and then trade back up to this orange. This is these white ones are sort of intraday. If you think of like day trading, not on a real short-term basis, but more of like multi-hours, that's what these white ones are. This purple one's beyond that. This is the swing trend oscillator. You took that out. This is the intermediate trend. Think like weeks or maybe months, and you're right back to it. The same day you had the flush. That's about as bullish as it gets, as far as I'm concerned. If you go on Twitter, Sven Henrich, I love his stuff, and he was seeing. I got to catch myself. I almost said he was seeing the same thing I was seeing, as if he cares. He don't even know why. Anyway, but he was talking the last few weeks. He had posted dollar index weekly chart. And he does a lot of channel work, whereas my regression lines, they're not channels that define highs and lows, although they sometimes do that. The regression lines, in my case, they cut right through the heart of where the bull bear price level is. But he posted a chart a week or two ago, weekly chart of the dollar index, and it's right back down to the bottom of the channel support on a weekly chart. Well, that was a week ago. That was back here. So now you've had the flush and reversal. So, you know, I don't know, but this isn't bullish equities to me. And I don't know how many people are left that want to buy Apple above, 425, whatever. Do we have another question? I don't look at the dollar a whole lot, because if you're a day trader, it adds a level of complexity that isn't necessary. The only time I look at the dollar is when you potentially have longer term, potentially meaningful turning points. And the European central banks are a mess. They are absolutely a mess. The blow off that we've had in NQ with you got 5 stocks: Apple, Amazon, Facebook, Google, and Microsoft, accounting for such a ridiculous, put it this way, right now the combined market capitalization of Apple and Microsoft is equivalent to the entire country of Germany. Everything. German automobile industry, everything. Does that sound, and look, here's the whole point. Could the market go appreciably higher than here? Sure. But when I look at taking a trade, 2 of the primary things I'm looking at is probability and risk profile. What's the risk reward? If you're buying Apple at 400 or 425, you may make money, but what's the risk profile? What is the potential upside versus the potential downside? And I can tell you this: if you were trading on Friday, I mentioned this earlier, and I don't want to keep repeating myself. We'll be here in another couple hours. That selling that we had off the open was about as violent as it gets. You did not, if you look at tick profiles, okay, you know, there was hardly a negative tick in that last hour, but you know, the tick profiles like watching paint dry. And so if you ask me what was the real move, the move down in the morning, the move up in the afternoon, what I would tell you is, well, I don't know, but metaphorically, if we get a heat wave in the morning and a raging snowstorm in the afternoon, you know, I mean, it's that absurd what we saw on Friday. And so, you know, it can run higher. Maybe it runs higher on Monday. But as someone who lives in Central Florida, one thing I've had marked on my calendar for several weeks is Disney's earnings Tuesday after the close. So what does Disney have? You got cruise lines, you got theme parks. You know, I just don't. And Disney is coiled. Disney is coiled into. All right, can you not let me out of this chart, Mark? There we go. We'll call this a bonus chart. How's that? What is it? DIS? What is Disney? Walt Disney, DIS.
DIS, yes.
Okay. And I don't know what time cycle we have this on, but you got a big old symmetrical triangle here. That's going to resolve one way or the other, and it's going to move either way. But there's nothing bullish about that to me. I mean, maybe they put up a good number, but you know, and that's not. I'm not saying the key to next week and the week after is Disney, but I know this. There's a lot of people who aren't paying their mortgage, that aren't paying their rent, that aren't paying their car payments. And, you know, at some point, the market cares about that stuff. So a market that when it was putting in the top, every time it got above 33.50, they'd hammer it lower. Well, what's happening now? Every time it gets above 32.50, they're hammering it lower. Only difference is they couldn't get price acceptance above 33.50 before the coronavirus. So how is all that going to work? At some point, the market cares, and you've got sentiment to an extreme. Go on Twitter and you know, just look for hashtags like stock market or day trading or stocks, and you see the number of posts for that stuff. That's a big red flag. So we're always going to trade both sides of the market. I mean, that's why we have a daily bull bear pivot. But one of these moves below 3,200 is going to stick, and there's going to be a lot of bag holders. And just going back to this ES chart, again, just in the last 3 days, Wednesday, Thursday, Friday, elevator up, elevator down, elevator up, elevator down, elevator up. This is the kind of volatility that you see before major turning points. Now, that major turning point could mean the next 100 handles are up. It could also mean the next 100 handles are down. But I was looking at some stuff today in the charts, and this looks very similar to what the market looked like the last time it broke hard. So, you know, who knows? Anyway, any other questions before we wrap? My wife's going to kill me if I don't acknowledge her presence.
Mark,
all right.
Great webinar, Mark.
Thank you very much. Zoom's supposed to record it, and if it did record it, I'll if it lets me, I'll email it out to everybody, and we'll post it on YouTube as well. Another question? Do the buy sell arrows print on your Zoom charts? Let me go back here for a second, because there are some of these panels where I've got arrows auto-populated. Now these big giant ones, those are ones that I put on there either to give you a heads up or because I'm doing a screenshot. But let me go back to, what is that one called? Live chart main from 728. It's in here. Third one. All right. So, for example, on the swing trade chart here, these are auto-generated by Thinkorswim. And what the criteria I put on here is, let's just take it from right here. When one of these 27-minute bars closes below the matrix pivot, it's going to give you a red arrow. Now, it's not going to do that each bar that continues underneath. It only gives you another arrow when the opposite happens. So the red arrow means this bar closed below the purple pivot. This one closed below the purple pivot, so you get nothing. This one closed below the purple pivot, you get nothing. Here, it closed back above the purple pivot, so it gives you a green arrow. And then the next arrow is when you had a bar that closed below it, and you know that was right before the bull bear pivot broke. And again, you know, it broke right before the day session open. This was published before 8 o'clock, the bull bear pivot. So you had a lot of things telling you there was a problem. So entering below that bar where you got the red arrow, or entering below the bull bear pivot, I was already short anyway, it didn't matter to me. So this one has those auto-generated. And this one's supposed to be, and it doesn't look like it does, so I'll have to fix that. Because the purple pivot here is the same math that's in this 27-minute chart, but this cycle is well over 2 hours. And I think I've got it over here too. I don't know. It's doing something auto-based. I'll have to look at that and see what that one is based on. But if you see the little tiny red or green arrows, that's being auto-populated by Thinkorswim based on criteria I put in there. Now, I can't get it to auto-populate when the day trade algo goes long or short, but it's real easy, like I said. Changing the momentum algo, and then you get the crossover in the volatility metric, but don't chase it. You got to wait for a pullback. I did not get long here at the end of the day, because by the time this thing fired, the first bar after it triggered long is right here. So I would have had to been buying this at 46. The only way I was getting long is if there was a pullback, and at that time it was already after 3:30 anyway. So, you know, but what I did mention on the member Slack channel, or the member live chart on the mic, was I pointed out right here where this bar came right up to the purple pivot, the matrix pivot. This bar came right up into it, closed here, and then boom. Once that thing went above it, that was the end of it. And so even though you've got an automated algo, you can trade just off these purple pivots. There was nothing at all wrong. And at the time when it first started going up here, this purple pivot was right horizontal to this one. And what I mentioned specifically that late Friday afternoon, I said, when you get these purple pivots lining up with one another, kind of like a picket fence, when it goes and you get price acceptance above or below those little picket fences, then you get fast moves. So even though the automated algo didn't trigger till here, you could have taken that long, because like I said earlier, when price is above the matrix pivot, you only have two choices: you're long or flat. When it's below, you're either short or flat. So, you know, you had an algorithmic long trigger here, even though it wasn't on the automated thing. But yeah, that's these little arrows, those are populated when bars open or close below, contrary to what had happened before it. Any other questions? Oh, you're welcome. All right, everybody, if you have any other questions, just let me know, shoot me an email, or hit me at direct message me on Twitter. There's all my contact info. Thank you so much. You guys probably know after 2.5 hours, I'm pretty passionate about this stuff. And you'll hear the backstory. And I'll just close with this real quick. I almost died in February of 2019. The My Pillow guy has commercials he's running. I'll make this real brief. He's got commercials that he's running about his book, his autobiography. And the announcer says on there that he's had 14 near-death experiences. I don't know that I've had 14, but I'm real close. And in February, it was like a mystery illness. February 2019, nobody knew what was wrong. Doctors couldn't diagnose anything. Problem was I couldn't eat for almost a month. And I remember I remember it like it was yesterday. The last 2 days of that whatever sickness it was a monumental effort to get the energy to walk from my bed to the restroom. And I remember laying in my bed that one night saying exactly, Lord, I don't know if you're ready to call me home tomorrow, but if you are, I'm ready. But if you're not, I'm going to change the way that I live my life. I've been a Christian since I was a little boy, but like, unfortunately, a lot of Christians, I spent a lot of my life running from God, or when I wasn't running from God, thinking I didn't deserve him. And I decided that was going to be the last time. Next morning, it was gone. Whatever it was gone. And just like they didn't know what was wrong with me, they don't know why it went away. Well, I think it's kind of clear. I think God was trying to get my attention. So, and I'll be happy to tell you that story in more detail. Periodically, I give you the longer version of that on the Zoom mic. But the point is this: I never intended to create any of this. After that sickness went away, I said a prayer, and the prayer was very simple. I said, Lord, teach me, and I don't even know why I said this prayer. I don't know. I said, Lord, I want to have a deeper relationship with you. Teach me your divine math so that I can understand you better and have a deeper relationship with you. I didn't even know what I was asking for. It wasn't about trade, and I've been trading for 37 years. I just knew that God's wisdom is not our wisdom. And the mathematics that he created the universe with, I just figured if I could understand that better, I could know God better and know his power and his wisdom and his glory and his majesty. And he gave me this. And I can show you with 1,000% certainty, no equivocation whatsoever, that the math that is in this system, there is a number sequence in astronomy that is in this system, and it is immutable. And that same mathematics exists in the periodic table of elements. I'm not going to tell you which ones to look at, but there's a reason this is called Mercury. People think it has something to do with the planet. It's not. It's that the mathematics in the periodic table of elements, if you know which ones to look at, absolutely is the same math that the planets are based on. Absolutely. I'll leave you with this. In all of that confirmation about this being rooted in astronomy, in the creation of the universe, in the elements that the universe is made up of, that was confirmed after this was all put together. I didn't go back and read W.D. Gann's stuff and say, because W.D. Gann started the same way. It started with an Old Testament Bible study, and it just developed into what he did. That's the same way this happened. But I didn't go looking in GAN's stuff saying, all right, let's see if I can find something, about God's creation of the universe and GAN stuff. I did not, and I've been familiar with GAN for years. But it was only after this was all built that I ordered some really esoteric material from GAN's family publishing company. And it confirms it. There's a book, and if you're interested in it, I'll tell you the name of it. But what it is, a guy named Billy, what was his name? It's right over on my shelf. But him and his wife bought GAN's publishing company back in the, I think, late 70s. And by buying his publishing company, he also had the rights to all of GAN's notes, a whole library full of notes. And he would publish these newsletters, and they were really, really detailed. I mean, like it takes you hours just to read one of them. And I got this book. In fact, it's right here on the shelf. I'll tell you the title. Billy Jones. It's called the WD GAN Technical Review. You will not find it on Amazon. The only place you can get it is from WD GAN's publishing company, which is WD GAN with 2 N's, WDGAN.com. I ordered, half a dozen other books. So what this book is, it's a compilation of all those newsletters that Billy Jones wrote after he went through all of GAN's unpublished notes, materials, archives. So you ever open up the Bible and you immediately look at exactly the verse that you need to minister to you at that moment in time? It happens all the time, right? I get this box of books. I take out the one on the top. It is 300 pages of really, really tiny font. And I open up directly to the one specific article that Billy Jones wrote about WD GAN's theory of how the mathematics of the planets are the same mathematics that govern financial markets. I can take this algo and put it on anything you want. Now, I can put this on Bitcoin. It works exactly the same way. It works on every instrument that we've ever tried because time is immutable. So you can use this on anything. Someone asked me, was it a week or so ago, if I can apply this to currencies. You better believe it. That's something I'm going to do soon. But I know it works. One of the foremost experts on WD GAN in the world is a woman named Olga Morales. You can find her on Twitter. She's a cosmologist by trade, and she probably knows more about GAN besides Billy Jones than anyone alive. And so back when I developed this, she and I were sending emails back and forth. And she lives in Australia. And she said, will this work on currencies? I said, I don't know. I've never tried. She said, can you run it for me with the currency pair, the Aussie dollar versus US dollar? And I sent it back to her, and it was one of the best trades you ever could have taken in that currency pair. It works on everything. So I'm going to stop now, or I'll keep going because I could talk another couple hours about this stuff. But if y'all have any questions, let me know. I really appreciate you being here, and I mean this sincerely. You being here today and listening to this for 2.5 hours is more a blessing to me than I can ever be to you. So I appreciate y'all being here. God bless you. God bless your family. And we hope to talk with you real soon.
Thanks, Mark.
Thank you.
Mark, real
Yes.
quick, what was the name of the lady's name again on Twitter? Olga what?
Olga Morales.
How do you spell her last name?
Morales. I think her Twitter handle is
AstroGan33?
That's it. Yeah.
Okay.
Yeah, and she is an astrologer too. but we're not talking astrology here. She's a cosmologist. We're talking about astronomy. She's trained in astronomy, but you know, the stuff that she does completely confirms, you know, the roots to GAN and astronomy and everything else. But to my knowledge, I'm the first person that tied this back also to the periodic table of elements, which further corroborates the math. But anyway, give me a call tomorrow. We'll chat.
You got it.
All right, brother. Take care.
Thank you. Bye.